So is the 4% rule officially dead? Is it dead? I mean, this is a long-held belief that if you follow this rule, this 4% rule, you can live the rest of your life and not have to worry about money at a certain point because you're going to follow this rule. So let's talk about this rule and why I think it may not, stand up in today's more modern or current environment. So first off, if you're not familiar with the 4% rule, we'll cover this fast. It basically means that once you save enough money that you can for retirement, that you can comfortably withdraw 4% of your savings in your first year of retirement, and then adjust that amount for inflation for every subsequent year without risking running out of your money for at least 30 years, right? So it's like, I've saved all my money, I'm going to start with 4%, and then I just adjust it up and down based on whether inflation or rising prices are rising or prices are falling, right? Now, there's some problems with this because it sounds so simple, but some of the issues are really related to the study itself, right? There's this big exhaustive study that kind of showed that this rule works. It really came from the study. So first off, the study was based on a stock and bond portfolio only. It was 50% stocks and 50% bonds. And it was like, well, that's not necessarily all of our portfolios. We might have some cryptocurrency, we might have some cash. So this is only based on 50% stocks, 50% bonds. So that's one weakness. The other is the study was based looking back at numbers over a 50-year period. Well, that 50-year period was from 1926 to 1976. Are things different than 1976? Are things different than 1926? Sure they are. That doesn't mean that things are not completely different. When we still have the stock market, we still have bond market, but we have other things too. We have other asset classes like cryptocurrency. We have certainly cash would be in there, as we mentioned, that's not considered. And it's a different world, there's different technology, all sorts of stuff. So that's a little bit concerning too. I'd rather see something from 1926 to today than, and actually I'd rather see even more recent, like in the 2000s even, than a 50-year period that ends in 1976. The other thing was, during this period of 1926 to 1976, this was developed when bond interest rates were much higher than they are, much higher. Thus, if you have 50% bonds and 50% stocks, but your bond part is paying you this higher interest rate, well, that's going to give you that automatic cushion in there, right? It's going to give you that cushion in there. Now, we do see bonds and interest rates and all that rising. We're starting to see a little more inflation, see more of that rising, but it's still not comparable to 1926 to 1976, so that's a flaw. Also, I think the biggest flaw actually is, and did you catch that part when I described what the rule was, that your money is based on your money lasting 30 years. The study was around between 30 and 33 years, that how long your money would last. So it's looking at 1926 and 1976 in terms of performance, and then it was projecting out that if you withdrew your 4% out and adjusted for inflation, that you could last for 30 years. But after 30 years, all bets are off, right? Then the thing starts losing control and the rule doesn't work. Well, a lot of us are looking to retire early. I retired early. I became financially independent early. I'm looking at 40, 50 years. Well, that's 4% so good for me. And also we have higher life expectancies. Let's say you retire at age 60, right? You could live to age 90. And for younger people now, you could well live over to 100. So do you really want to run out of money when you're 90 years old? No. So that 4% rule can be a real challenge with that. And I really have a hard time with that part. The other thing is, if you're taking a higher payouts early, let's say we have what's called a sequence of return risk. If things are bad or whatever now, or you need more money for whatever reason early, or maybe you want more money because you want to travel or do things when you're maybe in your 50s, 60s versus in your 80s and 90s, you might sell some stocks and sell some bonds at a loss early to cover those higher payouts. And that messes up the model too. And it also doesn't include taxes. I mean, we still got to pay taxes, right? It didn't consider taxes in this study. Or investment fees. You have fees, maybe you're paying a financial planner, or just the fees to own an exchange-traded fund or a mutual fund. In 1926, they didn't have mutual funds or exchange-traded funds. You didn't have that good diversification, but you didn't have the fees. Even if they're small fees, they're not considered in this study. So, as you can see, there's a lot of challenges with this. So what can you do? What are some things you can do? One is don't buy into these simple rules of thumbs of the 4% rule. It's a good place to start. And if you're looking to project out your retirement, you can use it to start seeing how much you're saving and are you on track. It's still a good guide, but I wouldn't rely on it. The other thing is when you get, especially as you approach retirement, you're going to look at what your actual expenses are. And then you'll be able to see what your nest egg is, and you'll look at your returns and look at your mix. You might want to put, I would say, put more in stocks, like 70, 80% stocks, especially as you're growing it. And then, but even as you get closer, you might still be more heavily invested in stocks because you might need to last for longer than a 30-year period. I'm financially independent. I'm still like around 80% in stocks, by the way. And I got all sorts of gray hair running all over the place. Look at it go. It's just out of control. Because I know the better returns like stocks get. And I have bonds. I have some crypto. I have a lot of different things. But, I would say I'm primarily in stocks for sure. So that's one thing. Those are a couple of things you can do. The other thing you can do is look at things like there's a bucket of money strategy where it's less about a simple 4% rule, but you're using different buckets. One's a current income bucket, one is feeding the income bucket, and one's more of a long-term growth bucket that feeds your more immediate term thing bucket that feeds your current income bucket. I have a full video around the buckets of money strategy. So do go to my YouTube homepage. You can watch that video. Hit the subscribe button. You can get all my videos. But if you go click on my image right and go to the homepage, you can find that buckets of money one. I also have videos around things like 4 quick ways to recession-proof your life or whatever. Those are things that can help you kind of get to your retirement goal. So the good news is you don't have to be too worried about this now, especially if you're in your earning years and your growth years. What you want to think about is saving as much as you can, investing as much as you can, and investing what your investments are, doing as smart as you can. In the description, I got all my courses, investing education with MrB.com. If you take some complete courses from me, if you don't take it from me, hey, go take it from somebody else who's really good or reputable, maybe some reputable books. Keep educating yourself. And then when you get to these things like around the 4% rule, or maybe you're talking to a financial planner and they're basing everything on a 4% rule, you're now more educated to ask more critical questions and think critically yourself and say, is this the right thing for me? So there you go. So in general, 4% rule, good rule of thumb, get you started. But boy, don't bet your life on the 4% rule would be my final thought on that. So I hope you enjoyed this video. If you did, hey, do hit that subscribe button. Check out some of my other videos, and I hope to see you in another video. And best of luck to you on your investing journey.